The challenge of following Greg. That's no small task, but I'm going to do my best there. For context, before I walk us through this, I'm going to give a abbreviated, quote-unquote, traditional outlook presentation, and on the back end, I'm going to connect it back to trade. I'm going to reinforce some of Greg's points and try to make some synergistic comments from what he set us up with here. As usual, you'll have access to these slides. I'll show you where that's at later. Now I can hear myself better. Hopefully that's better. Thank you, Tim. All right, real quickly. Who thinks we have tight supplies in the beef industry? Thank you for not raising your hand. That's an old story. It no longer applies, okay? We've increased the herd. We've increased weights. Last year we didn't, but in general we continue to do that. So commercial beef production is up. I won't belabor the numbers, other than that says it's very important to sustain demand. That applies both domestically and abroad. Greg just outlined a whole bunch of stuff on the abroad front of that. But more generally, as we've increased production, it becomes more and more important to understand demand and find the quote-unquote right households for those different products. The good news is in 2017, we had another Christmas surprise. So again, Greg noted the 2003 surprise, which was not desired for the beef industry. In 2017, we had a Christmas surprise that was. And what I mean by that was, particularly the fourth quarter, beef demand was much stronger than geeks like me were anticipating, and that allowed cattle prices to be higher than we thought. Particularly since about Labor Day of 2017, cattle prices throughout the whole chain have been higher than we anticipated, and that's because we've had a pull up on prices from the demand front. A lot of that is export oriented, but also on the demand front. I include here just a couple quick points for you. In the fourth quarter, we actually increased fed prices and calf prices compared to the fourth quarter of 16. Do we have more calves in the system than we had before? Yeah, right. There's more animals going through the system we had before. It's my job to geek out on economics. I'll try to keep it simple. The only way you increase price at the same time you increase the volume going through a market is for demand to be going up. Otherwise, you have downward pressure, right, when we increase volume. So if you want some things to stick in your own mind, fourth quarter price went up despite the fact that we had volumes moving through the industry was up. And that's the most simple summary of demand that I can give you. It's strong and it was real, and it added probably $100 of value to the quote-unquote average cow-calf operator that we didn't think was coming. I noted down here at the bottom, Greg made this comment, export value continues to be high. USMEF estimates this every year. For the last 4 or 5 years, that number's been over $250 of value is being added from the export front. So, $15 per hundredweight on fed cattle is coming from the export front, which is much greater than it was in the past. Okay? I know there's a lot of numbers here. I'm not going to read this to you, but I'm going to tell you the story behind it. Melissa McKendry is now a faculty member at Michigan State. She's a recent graduate of our department here at K-State. And one of the things she did was help us update some models to basically tell us what's the benefit to producers of changes in export demand or domestic beef demand. Again, I'm not going to tell you all of what's underneath that, but the very bottom of this, the numbers I have here mainly to remind me to tell you, is the demand increase in the fourth quarter of 2017 compared to the fourth quarter of 16 corresponds, per our work, to an over $5 per hundredweight value on fed animals, so those leaving feedlots, and almost $11 per hundredweight value on yearlings, so on 7 weights. Okay, so you do the general math on that, it's $70, $75 per head of value in that fourth quarter that's attributed simply to domestic demand increase. I've got the parallel numbers for export I could give you and so forth, but if you want numbers to go home with, it was real money in the pocket that followed beef demand being strong. I'm not here to give a full beef demand talk. You guys will want to eat lunch, so I won't try to do that, but I will note myself, Ted Schroeder, and Jason Lusk. Most of you know Ted, he's sitting in the room. Jason's now at Purdue University. We did some recent beef demand work. It was Beef Checkoff funded. I'm not going to belabor all that here, but I will call your attention to it. So later when you look at this on the beefboard.org website, you can find that report. We were tasked to try to understand what the recent determinants of domestic beef demand are, what's driving it, how sensitive beef demand is to pork prices and all that kind of stuff. If you want that information, I encourage you to get it. If you have questions about that, you're welcome to ask me about it. Okay, so now let's walk through real quickly some of this traditional stuff I normally do. Start cow-calf, work our way towards the end, and as I said, end on the export front. Talk about trade for a second before I ask Gray to come back up here. Cow-calf prices, normally we look at calf prices to start this story. These charts, I got about 6 of them, they're formatted this way. They come from LMIC, Livestock Marketing Information Center, based out in Denver. The current year is the solid blue line. Last year is the dotted darker blue line. I'm gonna point a couple things out. First of all, about the middle of October, the actual price in the Southern Plains for calves was $167, $168. Currently, our expectations for the same time this coming year, so middle of October 2018, are calf prices of about 172. Okay, that's the current best estimate. That only happens, I mean, time will tell if that's realized because we got to get to October for it to occur, but the current expectation of them still being stronger than they were in 2016 is because we think beef demand's pretty good, right? Cutout values are up, that confirms that, and there's a lot of components of that, okay? So 2018 is shaping up to be better than yours truly thought it would have been back as recently as Labor Day in 2017. This chart is some context going all the way back to 2003. It shows calf prices as well as for the year, as well as fourth quarter calf prices. And I'm not gonna read every number, but I'm gonna highlight the bump. So in 2017, Southern Plains calf price in the fourth quarter was 171 compared to 138 in 2016. So I made this point earlier, right? Calf prices came up because demand was strong. LMIC is expecting more like 150s for 2018-2019 fourth quarter price. So for those of you that are following me, that's 15 or 20 bucks lower than the number I showed you on the past slide. The past slide estimate was coming from a tool called beefbasis.com. It's driven by the CME futures prices and historic basis. LMIC has a slightly different approach to how they forecast. We could talk about that if you want. I don't have time to really geek out on it. But even at 155, which is the lower of those two prices I'm sharing with you, that would be a break-even year or slight positive for somebody that takes about $800 to run a cow for the year. So even if it was a break-even in 2018 for the average cost operator, remember where we're at on the herd expansion story. We pulled the trigger a while back, and if you're actually at kind of the top of the expansion and we're still having somewhat like break-even conditions, that's not normally how this works in a cattle cycle. Again, that's because beef demand is pretty good. This is profitability chart. You guys have seen this back to 1990. The punchline would be in 2017, we estimate a quote unquote typical cow-calf producer made 69, 70 bucks per cow. That was better than a $20 loss in 2016 and is expected, as I just said, basically to be break even here in 2018, 2019. Okay? It's not fun to talk about break evens, but if I was sitting here talking to you back, I keep referencing Labor Day because that's when we had a lot of the price escalation since then. We were talking notable losses in 2017, not a good 2017 and break evens after that. This chart is cost information USDA puts out. The only reason I include it is they suggest currently it takes about $800 to run a cow. Do the math on what that implies about a break-even calf price. That gives us about a $140 value of calves is what it takes to break even, right, to cover your cost. I highlight that because if we have 155, that means it's a small positive margin, right, to give you that context, but also because long-term, in a commodity industry like the cow-calf sector, we have some pressures that push those prices towards the cost of production. So you could think about this 140s number, mid 140s, as being kind of a long-term pressure point that we're going from a cost perspective unless we have continued demand improvement that allows us to get higher prices than that. Okay? This chart right here is simply to remind me to tell you, every January we have the cattle inventory report. Dr. Odie graciously noted I predicted slightly better than him to remind you of that. And do I need to say that again? Or, I think they got it. Yeah. Okay. I'm wrong plenty, so you got to be right every once in a while. Most recently, USDA's basically said, yeah, we've expanded the herd a little bit more, but not much. The punchline here would be is I think we're probably done expanding the herd. The only way we're going to continue to expand the herd would be have additional demand pull, which is possible if you want to be really optimistic. And I 100% agree with Greg's point. If that occurs, it's going to be from abroad, not domestically. So we could talk about that if you want. But in general, the industry's probably peaked out in terms of the size and the number of mama cows here. Okay? Now let's move past cow-calf for just a second. I reference beefbasis.com as a tool I regularly use. Once you get past the calf, when you think economics for background or stock or feedlot, anything where we're adding weight to an existing animal, the value of gain of that additional weight relative to the cost of putting those weight, that pounds on is what you got to talk about because that's really the margin that's of interest. The beef basis tool is helpful to give us an estimate of the value of gain component. So there's nothing there on the cost side. You got to compare there. But when you get into the revenue benefits of this tool is useful. And I just have one example. So this would be a summer grass potential one as of this morning. So I'm using last night's closes to do this. Potentially buying a yearling, say the first week of April, predicted purchase price of $158. Selling what I have up here is a 950 pounder out there around Labor Day. That corresponds to about 1.6 pounds of gain per day. Sale price 145 is the projected price, that is a value of gain that's north of $100. 108 is the number I have up here. Okay, so these are projected prices, both on the purchase and the sale price. But this gives you context about what the market is signaling those pounds will be. Now, for those of you in the back that can't read this, at the bottom in italics, a little bit like a lawyer would do, I put on here saying the drought monitor is going to have an impact. So collectively, the cost of doing this and the feasibility of doing this isn't quite the same around the countryside, right? So we had some moisture come through in the last 10 days, like we're all aware of some dry conditions. So the ability or the feasibility of doing this doesn't apply for everybody, and that's got to be kept in mind. If you start buying external forage that you don't normally do and so forth, those costs are going to be higher. So don't overreact to an attractive value of gain, but nonetheless use this tool to give you some insights on the value of gain part, and then do your homework on the cost of gain side. All right, I'm going to jump to here. Feedlots, 2017 was a much better year than expected. What I mean by that was, again, fed cattle prices came up because of demand beyond what we expected. Most months, somebody that placed cattle and had not hedged the output price benefited from that in 2017. That's not always the case, as everybody in the room well knows, but 2017 was a year where that was the case. In 2018, projections are starting to reflect the fact we've pulled back up those placement prices, and fed cattle prices aren't expected to continue going up. So if you follow that, we've squeezed margins again, at least from an expectations perspective. There's a lot of numbers here. My main point of including this is to remind you, once a month I put up on agmanager.info my best effort of projecting unhedged returns in the feedlot industry. I've highlighted 2 months, 2 closeout months, just to tell the story here. In March, I'm putting out an expectation of a positive $80, it's $82 is the number there, closeout, so that's a positive thing. But conversely, at the very bottom, closeouts for October are projected a loss of 137 bucks. So what's the $200 change? Where's that coming from? If you look through this, the placement prices are basically the same. 154 bucks for the yearlings going in is what's embedded in those numbers. But the fed price is 8 bucks per hundredweight lower on those October sales, and actually the cost of gain is a notch higher. I'll highlight that because my effort here isn't perfect. I can tell you how I do it if you want. But I do think there's some that have cost of gain well below how I have this set up. So those losses I'm projecting for October are not going to apply to everybody, particularly those that have access to one of those mountains of grain that we've all seen when you drive around western states. It's not a no-brainer to deal with that, but nonetheless, there are some that have access to lower cost of gain that is in this tool. My core point here is, unless we have really good cost of gain improvement or additional fed cattle price escalation, which will only happen because of demand, we're going to squeeze margins in 18 compared to 17 in the feedlot industry. Okay? LMIC puts out quarterly projections, and I'll wrap this part of this up. They do it basically for the next 2 years. The yellow bars are the annual numbers. I'm just going to leave you with the fourth quarter numbers for the calf side to make this point. In 2017, we basically expected, or we didn't expect, it's now realized, we increased beef production by almost 4%. That's the net of more animals and actually a little bit lower dressed weights. In 2018, we're expecting to have over 3% more animals go through the system and another 1% in dressed weights. So the net of that is over a 4% increase in commercial beef production. So more beef's going to hit the market. That's quasi-guaranteed. The only way that wouldn't happen would be a big reduction in weights, and I don't see how that would occur. So we're pretty sure we're going to have more beef pounds in 2018. In 2019, it's a continuation of that story, just not quite the same rate of gain. So there's more commercial beef that's going to hit the market in 18 and 19. We're pretty certain of that. What we're not certain of is the prices, of course. 2017, fourth quarter price for calves was 171. 5 market fed was 118. For context here in 2018, LMIC is basically saying a small pullback, 3 or 4% on the fed side. Over the calves, which is what most of the room cares about, they're projecting that mid 150s, which is the number I gave you earlier. So that is a pullback, right? Those prices are lower than the fourth quarter of 2017, but I'm trying to impose upon you some context. It's still break even or maybe slightly positive, and we normally don't expect that at this time of the expansion cycle. Okay? Now I'm going to try to transition, connect back to Greg's comments. Most of what I told you right there from a supply perspective was we've pulled the trigger, we have more animals and therefore more beef in the system. It's not unique to beef. So this is a pork slide. Commercial beef production is up and is expected to continue to be up next 2 years. So is broilers. You know, I'll ignore quarterly variation for a moment, but in total, red meat and poultry production and therefore availability in the U.S. is up notably compared to the past. Okay, this is the only annual export chart I'm going to include here. Greg alluded to this. This goes back to 1994. This is the volume of beef exports. you'll see the dip here in the middle. This is the BSE event he's referring to. We have recovered since then. Since 2016, actually 15, we've had notable annual gains in the volume of beef that's being exported, and that's a very good thing. He gave you a lot of information about that. I'm just reinforcing it. But I'm here to tell you we got to do more, and I'm going to try to tell you why that is. So raise your hand if you know how we calculate per capita consumption. I won't call you out. Thank you for raising your hand. It was tempting, but I'll put myself under the fire instead. It's what we produce plus what we import minus what we export. Take that number, and that's a beef volume number, divide by the U.S. population. So if you follow me, I never said price or dollar sign, right, A. But secondly, it's really just an amount of beef that's available here in the U.S. once we've adjusted for production and trade, okay? So before I give you numbers, if you follow how that's calculated, if we produce more beef or we import more beef, per capita consumption goes up, right? If we increase exports, per capita consumption comes down. If we decrease exports, per capita consumption comes up. That's just mathematical there, right? Meat is expensive. In the short term, we're not going to throw it away, right? So once we produce it, it's going to get consumed somewhere. It's just a matter of where it's going to get consumed and what price it brings in that market. So if you want to know why trade matters right now, hopefully I've convinced you the entire meat industry's pulled the trigger on producing more, and we have more and more here domestically. And if we can make gains on exporting more, it reduces pressure on the domestic per capita consumption front. That's why I hold your hand on how we calculate it. This slide is USDA information for the next 10 years. Ken would laugh every time I show this because, again, economists can't predict tomorrow, much less 10 years out. But nonetheless, it's a resource where we try to give some context of where things are going. And I'll give them credit because it is part of their job to try. And we have some insights on the supply side, how large the industry is going to be, because the number of cows doesn't move as much as some other things. And what we can get from that is per capita meat consumption, both in the near term and in the future. What I want to impress on you here is in 2019, USDA is expecting almost 61 pounds of beef to be consumed per person. For context, that's if it's realized, and I think it probably will be, that will be the largest amount of beef consumed per person in the US in 10 years. You go back to 2009 to get to the same number. At the bottom here, I've included, and I know you can't read in the back, you can look at them later, the total red meat and poultry number. We used to look at 220 pounds per person. Again, total red meat and poultry is a big number. We're going to exceed that. The numbers up here for 2018 are 222 pounds, and they get slightly bigger the next couple of years. So if I didn't convince you in the math that exports can have an influence, I'm sorry, I'll try again. But if you want to know why I talk about that, it's because we have a lot of meat here, and if we can accomplish growth in the exports, not just long term, but in the short term, it will alleviate some of that per capita availability pressure. And that's why a lot of people talk about it. But also the reason I walk through how we derive a per capita number is these expectations that USDA is putting out. The expectation of 61 pounds of beef in 2019 presumes we keep and slightly gain on the trade front. So I don't want to be a fear monger, but any step back on the export front will push up that beef consumption number in 2019 because I'm pretty sure we'll consume it. Beef is expensive, we're not going to waste it. But if we keep that here on the domestic market and we didn't plan on it, then we're going to have lower prices than we thought because stuff's going to stay in a second most valuable market, or maybe third or fourth, not what we thought was going to be the first most valuable market. Okay? I'm going to skip through some of these slides, mainly because I want to get back to Q&A with Greg, but I'm going to make a couple points to reinforce what Greg was getting at. When you look at the slides later, I've pulled together 3 or 4 that are pie charts like this to give you some historical context about where we've exported and imported. And Greg more or less told you this, but they're numbers to reinforce it. What this one is the most recent 5-year period, 2013 through 2017. What's the average annual share of our exports? He's already told you, right, Canada, Mexico, Japan, he walked through that. What I want to impress on you collectively is basically 30% of our volume, no matter when I look at it. So this is messy, there's 4 different pie charts for 4 different 5-year periods. No matter when you look at it, at least 30% of the beef volume exports stays here in North America. When you add up Mexico and Canada, that stays here. But what you don't get, if I stop right there, is there's been times when our North American partners have been even more important. And for those of you with good eyesight, you'll see down here at the bottom, I've got the 2003 to 2007 period, which is what includes the subsequent, the BSE event when we lost access, and Greg and others were working on that to get us back into Asia. Those pounds stayed at home in a broader sense. They stayed in North America. And over 50% of our volume share was going to Mexico on average for that 5-year period. So I'm trying to reinforce the point of all those markets are important, but there's certain points in time when our closer to home markets have been even more important. And I think it's useful for us to remember that. It wasn't that long ago, but it's easy to forget those issues from 10 years ago. Okay? Like I said, I'm gonna skip this. I'm gonna use this one. So US exports and US imports we could talk about. Greg's initiated that. I'm not gonna belabor that anymore. But I think it's important to go a little further and say, where does the US apply, right, and compete? And you gave us good examples on the Australian front, but more generally, who are the competitors and where do we stack up in the future per USDA's expectations? The top left is in one of these pie charts, and it's basically the global slice of the pie that major beef exporters are expected to have in 2018. The number, if you can't read it because you're not up close enough, is the blue one there is the US. It's about 14% of the US beef, of the global beef volume would come from the US. Now, value would be higher. This is a volume slide, so it understates the value part the US has. But what I want to highlight to you is the other major players, they have a lot of diverse systems. So Australia was talked about at length by Greg. I agree with everything he was saying there. They show up here as well. India is on this slide. New Zealand's here with a lot of similarities to the role of Australia, but it's not quite the same. I highlight the India one, not to pick on them, but just to make the point, they have a very different beef production system than we have here. And you can even debate whether we call it beef or not if we get to that point, but it is included in these numbers. But it highlights the comparative advantage, at least in my eyes, that the U.S. has to retain. And that's the the grain finished, that's not a good slip of a tongue, grain finished aspect of the U.S. beef industry. And that's very different than most our competitors, but especially the large volume coming out of India. And we got to keep that in mind. Going forward, USDA is expecting that pie chart not to change a lot, right? There are some shifts in this, but from a volume perspective, the total pie of trade is going to grow. Expectations are from a volume perspective, U.S. is not going to gain on that front. I'm a little more optimistic on particularly the value aspect of that than maybe U.S. is. But I share this with you just so you know who the main competitors are on the beef export front. This is a slide I've tweaked from the past. I made the comment, so did Greg, our comparative advantages are very, very important to understand. In the middle of this slide, Greg mentioned infrastructure. I 100% agree we have a lot of strengths in the infrastructure front. But I will say we got to be cognizant not to take for granted what we have. And I work at K-State. I'm a lifer academic, so you can put that as a bias point if you want in my next statement. But I do think there's a lot of, we take for granted that we have publicly funded research and knowledge and that part of the infrastructure. And that's a risk going forward if we lose that, because a lot of our scientific discovery over time has come from that mechanism. And while it remains a current strength, we should not take it for granted going forward. I include this slide, and I did this before I even met Greg again. When he was on campus last fall, he made a comment about one of these books, and I am the geek that reads a lot of stuff. So I've read 2 of these 3, and I'm part of the way through the 3rd one, but particularly he referenced the one that's all the way to your left. I want to reinforce the point that geography really matters on comparative advantage. I believed that before I read these books and before I heard Greg, but it was reinforced after doing both of those. So for those of you that want to know more details on this, I encourage you to look at these books. I don't get a commission for telling you to read these, that's not the point. But there's some non-economic parts about geography that have economic implications for those of you that think through it. And we do have a lot of unique strengths here in the U.S. The waterway system, the land base. While it is dry recently, we have different water systems than the rest of the world, rainfall and the river system. Lots and lots of that will probably be here to some extent no matter what political and governmental divides we have, right? Now, those divides can mitigate those benefits, but nonetheless, there's some permanent advantages to the U.S. ag system just because of we're sitting here with this physical land space that I think, again, we take for granted, we don't recognize, because a lot of our major competitors don't have the same thing. So as a reminder for that, these books, if you want more detail and don't just get it from the economists that are trained to talk about it, it's translated pretty well in those books. So what are some of our disadvantages? I don't think the U.S. beef industry is a lowest cost producer in several fronts, or particularly not when you just compare all protein the same. So instead, we got to have a quality aspect to our differentiation, and I think we have one there if it's grain finished, right? As Greg noted, Alberta would be in that story as well, for being honest, but in the grand picture of things, most major competitors don't have the same claim, and we can't lose sight of that. I will note here in the middle, I'm probably being too nice and polite when I say partially effective. The industry collectively works together and communicates vertically within the industry, sort of. I think there's a lot of room for improvement there. And the reason I highlight that is, more generally, we need to make some gains on the ID and traceability and information sharing front. Greg gave the examples in the packing plant and pushing the products through and tracking it. I 100% agree with that. And I'm pretty optimistic that technology will continue to get better. Where I rein on the idea a little bit is the industry's willingness to use and accept the technology probably needs to improve some also. So technical feasibility is necessary for us to advance, but so is acceptance of, right, and kind of attitudes around using that technology. And that's not a new challenge, but I'll just highlight it as, I see it as a disadvantage at the moment compared to some of the other competitors around the world. Okay? Now, here you're gonna think I'm doing this because Ted told me to, but I'm not. I'm gonna politely remind us, there's a lot of bright things said at these kind of cool events. Greg shared a lot of things that most of you haven't heard before. I encourage you to heed those comments. And I have 2 examples here from the past. Now, one of them, I didn't know Greg was gonna say this, but he actually said in his comments earlier. Paul Clayton, for those of you that were here, he was back here in 2014. He shared the quote, "We eat everything except the moo." All right, Greg said the same thing a minute ago. The reason I remind you of that is, if you really understand the importance of exports, pretty much every part except the moo gets consumed somewhere. Exports allow us to send those products to the markets that value them the most. And I always use the beef tongue example, where there's a long list of products that are worth more if they're not in the Tonsor, Kansas household, if they're somewhere else. It doesn't mean I'm right or wrong. I'm just saying different households value products differently. And if we have good trade, we're allowed to send those products to where they're worth the most. And when we aggregate them back up, you get the most value of that animal and that carcass. Any disruptions in that, we don't get maximum value. Remembering that we sell everything but the moo will stick in your head. That's why Greg told you as well. But Paul belabored that at depth, and I encourage you to go back and watch his recorded talk as well if you'd like. Ted down here at the bottom, he also shared some stuff that's embedded a little bit in my comments I encourage us to remember. His talk was in 2010, so this is 8 years ago when he gave a presentation, and one of the things that Ted was talking about was some concerns and trends he was seeing at the time in publicly funded investment in research versus private. And what Ted talked about then was there was a decline in public support, a growth in private. That has implications. I would assert that trend has continued since Ted gave that talk. It's part of why I'm reminding you of that. But the particular reason I'll highlight this is, at least to date, most private firms that are now a bigger part of the research discovery effort, they get their new talent, their new scientists, out of the public system. Now, it doesn't have to be that way, but to date, that's what it's been, okay? That model won't work forever if the public system's no longer kicking them out. So again, I work at K-State, I want to apologize for that, but I think there's some deeper thinking that has to occur on that front. And I'll just give credit to Ted for reminding us of that 8 years ago. Okay, wrap this up. CowCalf side, for those of you in the room that were just coming for outlook stuff, things are better than I thought they'd be because of demand. Your 2017 year was better than I thought they'd be because of demand. If you don't remember anything else from me, please remember that. We are probably at the peak of the expansion, and yet a typical cow-calf producer is not doing too bad. That's not normally the case. That's kind of an odd situation, okay? The middlemen, backgrounders, stockers, use the tools I showed you to get some projections on value of gain, but then I plead with you also to know your cost of gain. That drought feasibility issue and the spikes on your cost, if you have to buy forage in particular externally, might change whether those enterprises make sense or not. So please make use of some of those tools. And I noted here for the feedlot side of things, 2017 was really good. Some of my concerns on the 2018 front are, we're kind of presuming weights won't go back up. One of the reasons 2017 was good is we held weights in check. If grain gets cheaper and weights go up, that will put notable pressure on fed cattle prices, so we got to monitor that in 2018. So I'm going to leave this slide up, not that we have to answer these questions, but just to give us some food for thought if you want some planted questions. Why do we both import and export large volumes of beef? There's a long list of reasons for that, and I have an expert with me if you want to ask that. What are some of the pros and cons if you buy my assertion and Greg's that trade's important and maybe we're going to grow? What are the trade-offs of that, right? And at least I have some both pros and cons. I'm guessing Greg does too. I'll ask the question, should the U.S. invest more in growing the export front? And what you can't read in the bottom is maybe even a lost leader to where we purposely do it and we don't get the benefits for long-term. Should we do more long-term investing and less immediate reactions to what's on the ground today? And then fourth, how do I benefit from exports growing? If you want a basic example of what it's worth to me, I'm happy to answer that. So with that, Ken, I did my best to plow through this. And Greg and I, the best we can, we're happy to take questions.